Hello there, this is FairBinaryOptions.com, and we are continuing our Binary Options Academy project. This is our 20th mini project or mini educational series where we are showing you how to trade binary options here on FairBinaryOptions.com using technical analysis bites, if I may say so, or specific trades or specific patterns or specific scenarios that will help you finding the right place into buying call options or put options. Now, this time we are going to discuss about divergences or how to trade divergences, and in order to do so, a divergence, you need to compare the price or the moves made by price. You need to compare them with something, with an indicator. Now, there are indicators, there are trend indicators, the ones that are following a trend, or indicators that are actually oscillators, and they are, let's say, imitating the moves of a security, or in this case of a currency pair. What I'm going to show you is one of the most popular indicators of them all. I'm talking about the relative strength index. So if you click here and you want to add indicator, the relative strength index actually comes in the momentum indicators. This is the J4X trading platform, but exactly the same is happening on the MetaTrader. But on the MetaTrader, you just go on the indicators and then on the oscillators tab, and I think the first position there or something like that, under the oscillators tab, you have the relative strength index. Well, let's try to find out the relative strength index here on the momentum indicators. So this is relative momentum. Let's see what it is. Relative strength index. And if you click on it, this is the oscillator. Always use, or at least this is my recommendation, use the standard or the default period there, 14. And what does it mean? It means that the oscillator takes into consideration the last 14 candles when plotting that line that you're going to see on the screen. That means that if you're looking at the 1 hour chart, the oscillator is the result of the last 14 candles, or the last 14 hours, and the value that you see on the oscillator is calculated based on them. If you are trading on the 4 hours chart, that is basically taking the 4 hours chart as well. If you are looking at the monthly chart, then it takes 14 candles, 14 months. Now, clicking OK, and the oscillator appears on the screen, and as you can see, this is the result, or this is the relative strength index plotted on the 14 period, on the 1 hour chart, on the Great Britain pound US dollar. Now, normally this is coming with the 70 area here and the 30 level. Anything that is considered to be above the 70 is considered to be a bullish, an overbought area, and price should go to the downside. So if you are trying to look for a place to buy put options, that would be the moment, because that area is considered to be overbought. Or if you're looking to the downside on the 30 level there, then that area is supposed to be considered an oversold area, or the oversold level, and we should go and buy call options as a result. Now, this is the standard interpretation on the relative strength index, but normally what I really like to show you here is how to trade the divergences based on the RSI, and the divergence on the RSI stands with the following. Well, first of all, it should be mentioned that the RSI or any other oscillator that you are looking with and the price, they should move together. It means when price goes to the downside, like it is here, the oscillator should confirm the move and go to the downside. When price moves to the upside, the oscillator should move to the upside with no let's say discrepancies. Now, we should look, a divergence means when something is not right. I mean, price moves to the upside, but the oscillator is not confirming. Or price moves to the downside, but the oscillator is not confirming. That is a divergence. We like to buy call options or put options when price or when oscillator is diverging from price, or when price is diverging from the oscillator into the overbought or the oversold area. In our case here, put it simple, look at price and oscillator with one simple interpretation. One of them is lying when a divergence occurs, and we should always stick with the oscillator. Why? Because, for example, here, as you can see, price makes a high, the oscillator makes a high. Price makes another high, but the oscillator is failing to make another high when compared with the previous one. Well, this is a divergence into the overbought area, and normally we should look into buying put options as from that moment on. It is giving us a clue that somebody or something is lying here. A move is fake. Now, this move is a fake move, and we should stick all the time with the oscillator. Why? Because it takes into consideration 14 periods. Now, price here is single, but this move here takes into consideration the last 14 candles here. So I would be interested to see, of course, or to stay with the oscillator and not with price. Let's see some classical examples in the second part of this project. This is only the first part in trading divergences, and of course we are using for divergence the most popular oscillator of them all, the relative strength index. Thank you, and moving on. Here is binary options, fairbinaryoptions.com, and all these are possible due to the help of our sponsor, Lionite. Bye bye.